In a matter of days, one man erased more than $100 billion from the stock market. Not a bank, not a country. One man running money out of a family office most of Wall Street had never heard of. He gave hundreds of millions to charity and was known as a devout Christian philanthropist. But a jury would come to call him something else, guilty on 10 counts of fraud and market manipulation. This is how Bill Hwang built a $160 billion empire that no one could see, and how it vanished in a single week. To understand the collapse, you have to understand the myth. And on Wall Street, few myths were stronger than the Tiger Cubs. In the 1990s, Julian Robertson built Tiger Management into one of the most successful hedge funds in history. When Robertson retired, he seeded his best analysts with capital to start their own funds. These hand-picked protégés became known as the Tiger Cubs. They were Wall Street royalty, and Bill Hwang was one of the brightest among them. In 2001, Hwang founded Tiger Asia Management. He focused on Asian equities. He was brilliant. He was aggressive. And for a decade, he generated massive returns. But Hwang's edge wasn't always legal. In 2012, the machine broke. The SEC accused Tiger Asia of insider trading and manipulating Chinese bank stocks. Tiger Asia pleaded guilty to wire fraud, and Hwang settled with the SEC for $44 million. 2 years later, in 2014, regulators in Hong Kong handed Hwang a trading ban. In the eyes of the global financial system, Bill Hwang was toxic. Traditional prime brokers, the massive bank divisions that lend money to hedge funds, were told to stay away. His hedge fund career was effectively over. But Wall Street has a very short memory when there is money to be made. In 2013, Hwang restructured. He returned all outside capital and rebranded his operation. He called it Archegos Capital Management. It was no longer a hedge fund. It was a family office. This distinction is everything. In the United States, if you manage money for outside clients, you answer to the SEC. You file public disclosures. You list your holdings. But a family office manages only the wealth of its founder. Because there are no outside investors to protect, the regulatory net simply vanishes. A family office operates in the dark. Initially, major banks refused to do business with Archegos. The compliance risk was too high. But Hwang started small, generating quiet, steady, massive returns. Slowly, the prime brokers noticed. First, the smaller firms offered him credit. Then, the European banks. Eventually, the allure of millions of dollars in trading fees became too much to resist. Even the elite American banks welcomed him back. Bill Hwang was inside the system again. But this time, he wasn't going to buy stocks the normal way. He was going to use a financial weapon that would make him completely invisible to the market. If you want to buy $1 billion of stock, you usually have to declare it. The world sees your position. But Hwang didn't buy the stock. He bought derivatives, specifically total return swaps. Think of a swap like a massive, high-stakes casino. Imagine walking into a private room. Instead of sitting at the roulette table and placing your own chips, you hand $100 million to the casino manager. You point to a number and say, "Place the bet for me, but do not tell anyone it is my money. If the number hits, pay me the winnings. If it loses, keep my cash." In the financial world, the casino is the prime broker. Banks like Credit Suisse, Nomura, Morgan Stanley, and Goldman Sachs. Hwang went to these banks and asked for total return swaps on specific companies. The bank would go into the open market, buy the actual shares, and hold them on their own balance sheet. The bank legally owned the stock. But through the swap agreement, they promised to pay Archegos any profit if the stock went up. In exchange, Archegos paid the bank a fee and promised to cover any losses if the stock went down. Because the banks held the shares, Bill Hwang's name was on 0 public filings. He was a ghost. It's worse. Hwang didn't just go to one casino. He went to all of them. He bought swaps with Credit Suisse. He bought swaps with Goldman Sachs. He bought swaps with Nomura. And because these are fiercely competitive banks, they didn't talk to each other. None of them knew what the others were doing. None of them realized they were all placing bets for the exact same ghost. This anonymity allowed Hwang to use terrifying amounts of leverage. For every $1 of his own money, banks were lending him $5, sometimes $10 to amplify his bets, and his bets were intensely concentrated. While a normal fund diversifies across hundreds of companies, Archegos funneled billions into a tiny handful of stocks. His primary targets were legacy media companies, most notably Viacom CBS and Discovery. As Hwang bought more swaps, the banks had to buy more of the underlying stock to hedge their own risk. This massive, relentless buying pressure drove the stock prices higher. As the stock prices went higher, the value of Hwang's swaps exploded. He took those paper profits and instantly used them as collateral to borrow even more money, to buy even more swaps, forcing the banks to buy even more stock. It was a perpetual motion machine of pure leverage. The growth was completely staggering. In March 2020, Archegos had about $10 billion in total market exposure. Exactly 1 year later, in March 2021, that exposure had mutated to roughly $160 billion. At his absolute peak, Bill Hwang's actual net asset value, the real money he controlled, was $36 billion. It made him one of the wealthiest men on the planet. And almost no one knew his name. The machine was flawless. The math worked perfectly, as long as the stocks never went down. On March 22, 2021, the machine broke. Viacom CBS executives looked at their soaring stock price. It had increased by hundreds of percent in a matter of months. Management decided to take advantage of this miracle run. They announced a massive $3 billion stock offering to raise cash for their streaming service. Wall Street hated it. The announcement diluted the value of existing shares. The stock price immediately began to crack. It dropped 9%. Inside the Archegos offices, alarm bells went off. Because Hwang was so heavily leveraged, a small drop in the stock price meant massive damage to his portfolio. The banks required him to maintain a specific ratio of cash to debt. When the stock dropped, that ratio broke. On March 23, 2021, Hwang tried to fight the market. Prosecutors said Hwang ordered his traders to buy nearly $1 billion more of the sliding stocks, frantically trying to prop up the prices. He was trying to overwhelm the sellers with sheer volume. But you cannot outbuy the entire stock market. The slide continued. By March 24th, Hwang made a final, desperate attempt to hold the line. It failed. The value of his swaps was collapsing. And suddenly, the banks woke up. The prime brokers looked at their screens and realized the collateral Archegos had given them was no longer enough to cover the plunging value of the positions. They issued margin calls. They demanded Hwang wire them billions of dollars in cash immediately to secure the accounts. Hwang didn't have the cash. A prime broker has a simple rule. If a client misses a margin call, the bank seizes the assets and liquidates them to protect itself. But there was a massive problem. The banks finally looked around and realized they were all holding the exact same stocks. If one bank panicked and dumped billions of dollars of Viacom CBS onto the open market, the price would instantly collapse, and every other bank, though holding the stock, would suffer catastrophic losses. On Thursday night, the major banks held a frantic emergency call. They tried to organize a truce. They wanted to slowly, methodically sell off the Archegos positions together so they wouldn't destroy the market. But there is no honor on Wall Street when billions are burning. According to reports, Goldman Sachs and Morgan Stanley listened to the plan. Then they hung up the phone, broke the truce, and immediately began dumping billions of dollars of stock into the dark pools and open markets before the opening bell. They got out first. The remaining banks were left holding the bag. The fire sale was violently fast. The stock prices of Viacom CBS, Discovery, and several Chinese tech companies entered total freefall. When the smoke cleared a few days later, the carnage was historic. More than $100 billion in market value had been wiped out. The banks that were too slow to sell suffered brutal, humiliating losses. Over $10 billion in bank capital vanished. Nomura lost roughly $2.9 billion. Credit Suisse took a catastrophic hit, losing approximately $5.5 billion. While Credit Suisse was not destroyed solely by Archegos, it had years of deep-rooted cultural and risk management failures. The Archegos wound shattered market confidence in the institution. It was a massive, bleeding vulnerability that ultimately helped lead to the bank's complete collapse and forced takeover in 2023. Bill Hwang's $36 billion fortune went to zero in a matter of days. The federal government did not view this as a tragic market accident. They viewed it as a crime. On April 27, 2022, the SEC and the Department of Justice brought the hammer down. They charged Bill Hwang with racketeering, fraud, and market manipulation. During the trial, prosecutors laid bare the mechanics of the illusion. They showed how Hwang lied to the banks about his portfolio size, how he promised them he was liquid when he wasn't, and how he weaponized his trading desk to artificially inflate stock prices. In July 2024, a federal jury found Hwang guilty on 10 of the 11 counts he faced. The invisible empire was fully dismantled in a public courtroom. On November 20th, 2024, Bill Hwang stood for his sentencing. He stood before Judge Alvin Hellerstein, a judge who has seen the absolute extremes of modern corporate deception, presiding over other high-profile fraud cases, including that of Frank founder Charlie Javis. Hellerstein looked at the sheer scale of the financial destruction. Judge Hellerstein sentenced Bill Hwang to 18 years in federal prison and ordered more than $9 billion in restitution. The story of Archegos Capital is not just a story about a man who flew too close to the sun. It is a story about the structural blindness of the modern financial system. The banks thought they were managing risk. Instead, blinded by fees, they handed an exiled trader the matches and the gasoline and locked themselves in the room with him. Hwang believed his own myth. He believed he could command the markets in secret. But hidden leverage only works until the tide goes out. And in the end, no amount of faith, no amount of silence, and no amount of leverage can outrun the cold, brutal reality of the math.